Hello everyone, welcome back to my channel, and in this video I'm going to discuss a very important topic, and that is how can you use trading psychology to improve your options trading and earn money from trading. Right now, in a lot of videos and in a lot of places you must have heard traders and people talking about trading psychology and how important it is, but you have not been able to figure it out that how can you use trading psychology in your trading journey, right? In what way will it help? Now in this video I'm going to give you a practical example of how I use trading psychology to earn money in trading, right? Now, before I start, I want you to remember two important rules, which are very important if you want to do good in this trading game. Right now, the first rule is that always remember that market never moves in a straight line. Right, but even if the market has to go higher, it will go a little bit higher, then it will correct a bit again, and then it will go higher. It will never go in a straight line. And in the same, even in the downwards direction, also is the same thing. Whenever the market has to fall, it will not fall in a straight line until unless there's a very big crash, a very big reason for the fall, like the COVID crash, right? Otherwise, the market, if it falls, it will correct a bit, it will rise a bit when the people who have shorted, who will book the profits in the when the market is a bit lower, so the market will rise a bit and then it will fall. So it will not fall in a straight line. And the second rule is that in the long run, the market has to go higher. And that is what the whole mutual fund industry is based upon, right? In the long run, even if there's a 10% correction, 20% correction, 30, or like the COVID crash where we reached up to around 7,500, the market did rebound. So in the long run, the market has to go higher, and that these are two rules which we will utilize when we are doing trading. So let us head to the charts. So here I'll show you one of the recent trades which I have taken on Twitter. Okay. I posted on 29th August when there was a huge gap down, as you can see here. There was a Fed event on the weekend, and so on Monday there was a huge gap down, right, around more than 400 points. Like it was the second highest gap down this year, right? So market opened somewhere around 17,180, somewhere around that area, right? Now what happened was, as soon as the market opened, and there was a lot of people panicking, and in Twitter there were many people who were saying that okay, the market will now go to 14,000, 15,000, 12, even some are even claiming 12,000, right? There was a lot of panic. So what happened, a lot of people started shorting calls and buying puts, right? There were many people who started shorting 17,500 and started buying puts, right? Now now you need to first understand, why was there a market fall? What happened? Like there was a Jackson Hole event, and where the statement given by the Fed was a bit hawkish, right? But it was not something out of the blue. We were expecting some sort of a statement in the weekend, right? It was already pre-planned. It was not something which happened all of a sudden, like the COVID crash. So you need to understand the reason for the fall. Why is the fall happening, right? Now if the fall is just because of a panic selling, or no, just a short-term event, then you can't expect the market to keep on falling. Like it can fall further, but obviously it will not fall like what happened in the COVID crash. So what did I do? I started looking at the premiums of the puts and the calls, and what I saw was, I just posted it on Twitter as well, that 16,700 put option, right? The market opened around 17,200, right? So 16,700 put option was still 500 points away, and that was giving me a very good premium, that is 20, around 21 rupees, right? Right. And I didn't trade as soon as the market opened. I waited 5 or 10 minutes. I saw first what is the market doing. Are we getting more selling pressure? Like I'll show you in the graph also. If you see the graph for the 29th of wait, let me show you. Yeah, if you see the graph for the 29th of August, this is 29th. As soon as the market opened, we saw some recovery. So you kind of know that okay, it is not something that is, as soon as it opens, the market keeps on falling. It is not that sort of a market right now. So what did I do? I just went and sold Nifty 1,000 quantity of 21 rupees, 16,700 put option. Now by selling 21, I was getting my 1% for the week. So I did not have to do anything else. I did not have to do. I just went and sold, right? Now what I did additionally was that as soon as the market was recovering a bit, uh, I went and sold 17,800 call option, because I was not expecting, okay, I was expecting that there could be some recovery, but I did not expect the market, but what eventually happened was that the market did go up to 17,800, as you can see in the graph, but I was not expecting it to go so much, but still at the end of the day I came out in profits. But see, what is important to learn here is that as soon as this market started recovering a bit, people had shorted the 17,500, because they were not expecting the market to go up to 17,500, because if there's such a huge gap down, people were expecting it to fall further. And what happened eventually? The market, it shot up anything, and it went up to 17,000, approximately around 17,800. So the people who had shorted 17,500 were in heavy losses. Right, on both sides they were facing losses. First they were facing losses in the put side, and then they started facing in the call side. So what you need to understand here is that whenever the market falls, first try to understand. Now this is a part of the trading psychology, right? What I told you in the beginning, the rule number one, the market never moves in a straight line. Even if it has to go down, it will have to halt a bit and trade in that range for a while, and then only it will fall down. But in this case it did not fall down, it started recovering. So what I did was that, to be on the safe side, I could have sold 17,000 put option also, but to be on the safe side I sold 16,700. And if you are getting one profit by selling 16,700, and why to take additional risk? What you could have done is that, once since the market started rising, you could have brought your puts which are sold closer to the strike price, nearest strike price, right? That you could have done. But other than that, there is no reason to panic in such sort of a market. So guys, hope you enjoyed my video. Do subscribe, and if you have any doubts you can put it in the comment section below. Thank you.